strategy. So I actually want to start with you because we just did a radio show. How many of you are Real Wealth Show listeners? You have some listeners? I'm so glad because we get to do some things on there that we don't do in the webinars or even at these meetings. I get to interview a lot of people and have had, I think everybody on here has been on the show, sharing their stories. And so yours isn't up yet. So
that's true.
Yes, but you spent some time on the show talking about your strategy and how you came up with that. So if you would share again.
You asked me what I thought was really important in all this, and I said that I think you need to know what your strategy is going in before you make your first purchase, because what you buy is dependent on where you're trying to go with it. And so, for example, myself, I was a small business owner, and I retired and sold my business. And so I have this chunk of money that I needed to do something with that I got from selling my business. And my income went from something to nothing overnight. I don't have any income now, which is fine because I don't want to work right now.
Because you also get a chunk of money.
my strategy is to maximize income because I've worked all my life and I've saved money in IRAs and different things. But the less of that I can touch, the better off I'm going to be over time. In a perfect world, I wouldn't have to touch anything that I've worked for up to this point and would be able to live off income that I could get from what I've got. So that's what I was trying to do, and that's what I am trying to do, is maximize income, because otherwise I have to tap my principal, and I would just as soon not do that or do it as little as possible. Maybe that can get passed on to my kids someday if I'm lucky. So I started about a year and a half ago with this chunk of money, and I came to some of these seminars and I learned some things, and it all made sense to me. I had no experience in real estate, but I couldn't find anything wrong with it. And so I started by buying 3 houses, and now I have 10 houses, and I still have a little bit of money left. I think I can get about 2 or 3 more, but once I have those all in place, I intend to be very minimally involved with this, and that's the way it's worked out for me in the last year and a half. I mean, basically all I have to do is collect the money.
And so, but you had a very specific strategy in what you were looking for. So it's really easy for you to determine the market and the type of property. You weren't necessarily interested in a lot. It was mainly single-family homes, right? Mm-hmm. So not multifamily. One thing I want to make sure is really clear is there's a lot of options. You can do private lending. You can do commercial. You can do apartments. You could do tax liens or flips. So it can be it's easy to get distracted and to jump into something that you don't really know that well. So the best advice when you're starting is to hone in on one thing and get really good at it. And that's what you did. You were so specific. So if you would share exactly what those parameters were that made it so easy to say, this doesn't work, great team, great market, doesn't work though, I'm looking for this. What was it?
I've talked to other investors, and everybody has their own comfort level. I mean, there's some people who just buy stuff sight unseen, they don't know anything about it, and they just trust. And then there's other people that go to the opposite extreme, and they research forever, and they get stuck. So I'm kind of in the middle of that. My level of comfort was I wanted to go meet the affiliates in these other cities. I wanted them to show me the neighborhoods. I wanted to see that they had a real office with people working in it. I wanted to see how their management wing was operating. And so I got to know them a little bit, and they got to know me a little bit and know what I was looking for. And once I get to that level of familiarity, some of my homes I picked out one by one when I was visiting these places. Other ones I bought sight unseen based on pictures and based on their performance, but only because I knew the team.
And you've been to that
And
market?
I've been there and seen it. Because there was a couple of markets that I looked at, 2 of them, that I absolutely would not buy anything there. I wasn't interested. And I wouldn't know that had I not gone to look at it.
But interestingly enough, those 2 markets have been to other people's favor. So everybody has their strategy. And it could have been that the time that he was there wasn't anything good. Another point I want to make clear is that real estate's not a commodity. It's not oil and gas and gold and silver. It's different every single transaction. Every single one, even if it's on the same street, it's different. So you could say, I had the most wonderful experience in Pittsburgh, and you could say, I didn't, and why? Because you had 2 different properties, right? So and maybe didn't do the same, and I'm not picking on Pittsburgh, I don't know if that was one of the cities you were talking about, but then you've got other people who absolutely love it, so.
And the problems that I had were not with the cities. I would go back and purchase a property in those 2 cities. What I wasn't happy with was the people that I got put in touch with. And I don't know if that was me or if it was them, but the point was I didn't feel comfortable with those situations. And there's other choices. You know, you gotta feel good about it going on. So my strategy is to maximize income. That's what I need at this point in my life. If the homes appreciate in value, that's just gravy, you know, but that's not what I'm looking for. But 20 years ago, when I was in my peak earning years, I didn't need any more income because I already made enough money. So my strategy 20 years ago would have been completely different. I would have thought of ways to defer the income now and try to build more equity and try to purchase homes that had a greater appreciation potential. Whereas for me at my age, that was secondary.
Okay, thank you. All right, who wants to go next? I guess it's you. All right, well, strategy.
All right, so strategy, very similar to Wes in many regards. I think the very first thing is can you hear me all?
Yeah.
Okay. So the very first thing I did is, I'll admit that I was not a real estate investor until 2011. Actually started in 2010 and started looking at properties in the Bay Area, bought some properties in the Bay Area, and at the same time purchased those properties, came to some of the Real Wealth Network sessions, and sweet spot, right?
Yeah.
And in coming to the sessions, I'll be candid, I spent a year and a half coming to sessions, listening to webinars before I even considered making an investment through Real Wealth. A lot of due diligence, same as Wes indicated. So what I ended up doing is my strategy was twofold. One was purchase some properties in the Bay Area, which I knew had upside potential in terms of appreciation. In 2009, 2010, if you weren't in the market, it was a great time to be in the market because things were dirt cheap. People were giving away houses, the banks were giving away houses, and we were fortunate, my wife and I, to make those purchases. Then what I did is then at the same time, looking at that component, the other strategy was how do we generate income in the future. And so one of the things that what caught my eye was one of the presentations that Missy presented, and I was in attendance at, and she had a 10-year plan. And it's something, if you haven't spoken to her, I highly recommend you speak to her regarding her 10-year plan. And so we went down that route of a 10-year plan, not necessarily buying as many properties as she indicated in her marketplace, but using that concept, we went forward in 2011 and started looking at things. We actually made our first real wealth net purchases last year. In fact, this month was the first month that I'd say we were anniversarying one of our properties. We ended up purchasing 11 properties last year in a 6-month period. How were we able to do it? Well, I did a podcast with Kathy last October, and I'll share with you what we ended up doing. We sold a property that we had purchased in 2011. We sold last year in May, and the proceeds from that purchase, we were able to buy 5 properties in Cincinnati. So no cash out of pocket whatsoever. In fact, if anything, this whole process, we've driven all of this through just refinancing our house. So we never taken any cash out of our pocket to buy any of the properties we have. It's all been funded through income from all the properties. So that was our strategy, and that's the way we're rolling with it. And I would say, as far as due diligence,
we'll do that.
Okay, we'll do that next.
Question.
But that was our strategy, and that's the pace we're on, and we have this 10-year plan. And once we get to the 10-year plan, it's kind of like do what we want. We go, you know, do we want to work or not want to work type of thing.
So to define,
So Walt, where can you tell us where the 11 are? You said Indianapolis?
Indianapolis and in Ohio. Those are the 2 markets, and then we also have properties in the Bay Area.
So the strategy initially was to just take advantage of the opportunity in California.
Absolutely.
Then once those prices went up, exchange those for higher cash flow properties.
We actually exchanged just 1 property.
Okay.
That was a condominium we had purchased in Walnut Creek, and purchased 5 homes in Cincinnati.
So 1 condo in Walnut Creek and bought 5 homes. It's amazing.
Yeah.
Yeah. And you got the Walnut Creek property for a steal.
Yeah.
At the time.
Yes.
Yeah.
Gross
Yeah.
deal.
Yeah, good for you. Fantastic. Wayne and Danelle, who's going to go first?
Okay, I
I'm
guess
not
I
giving
will.
last names for asset protection reasons, by the way.
So I agree with you, Kathy, the importance of anything. Strategy is important. You wouldn't expect to win in sports unless you knew the rule of the game. You wouldn't expect to win consistently unless you had a coach to help you win. So if you want to think of it like that, you have access to resources here to coach you to get in the game. And that's how we started. Well, Danelle gave me a lot of information, let me just say that. And we came to one of the sessions here, and Missy was speaking also. And she talked about her strategy of 10 houses in 12 years, totally paid for. And it just clicked. Actually, we were going to invest with another vendor, but then after we listened to Missy, we were both very comfortable with investing with her. There's just, I don't know how to explain it. We wanted to be hands-off. We didn't want to be messing with investments because we had a property that we originally lived in. It was in another state. It was a condo. And I was in the military at the time, so I was overseas, and we continued to manage it from overseas. And one of my tenants almost burned her place down. I mean, she unscrewed the light fixture, and the wires were sitting there hanging and stuff. And I knew I didn't want any of that. And talk about sleepless nights. You're on the other side of the globe trying to fix this stuff on the phone, and it was just a bad deal. So we decided we initially were going to go forward with letting the properties pay for themselves. Leverage them, use a Fannie Mae or Freddie Mac loan, and you leverage out, and then you just let them pay off, let the renters pay it off. And it sounded like a great idea until we started getting, one of us is a crazy maker and likes to buy stuff. And I started buying more.
You.
Yeah. Well,
Danelle's the researcher, and you were the frenzied buyer.
Here's the information.
Every family's got that dynamic, right? Right, honey?
so someone has to tip the tables upside down, and it might as well be me.
Me
So,
too. Yeah. Thank you. I feel heard.
until it starts getting messy, and we understand there's a balance in life. So we're working on that. So we had bought these properties, and it's been really simple with Missy. And as we bought more and more, we realized that, hey, our strategy started to change.
Okay.
We went from a...
What was the initial strategy?
Well, just for a retirement fund for Janelle.
Yeah, well, actually, kind of the initial strategy too was basically not to do what we were already doing because it wasn't working. We just were letting everything run on its own. And once we got to California, we realized, hey, our finances, there's more taxes coming out. We don't have the military tax deduction advantage, all these things that we just couldn't take for granted. So we really started looking at it. We said, okay, that our strategy, step number one, don't do what we're doing now. So then we found this thing called real estate through Google, and then Google led us to Real Wealth Network, and then this whole thing, and then we started going to sessions, and we learned it's like, oh, there's passive income, and it sounds like it works, it sounds like a really good team, and we can hand it off to them with their expertise, and just plug into an existing system. So that was really kind of a simplistic strategy, step number 1, 2, and 3 from there. And then once we figured that out, we moved forward.
See, I had a retirement plan through the military, but Danelle didn't have one. And I realized by the way we exited the military that wouldn't be passed on to Danelle at all. So I started having trouble sleeping at night, to be honest. I did. And so we started looking at what was out there that could create cash flow at a reasonable amount of risk. And it was real estate. And Real Wealth Network, we liked the idea of being able to leverage experts that have already been pre-screened, right? You're still, life is messy. You're always going to have stuff that's going to surprise you. But at least you don't have to be surprised from people who, or you hope, I should say that. They've been pre-screened and ethical, that they won't change their current behavior. Okay, I think that's fair to say. So based on the steady state that we saw, these people seem ethical, people we want to work with. And then as our cash flow began to increase, we came with the realization that one of us wouldn't have to work anymore. And that was Danelle. And then that's when our strategy started to shift, because then we started looking and we're like, well, if we pay off these loans, we lose these write-offs, right? Because there's the interest that you would lose. So we decided, well, why not just take cash flow from the properties and let that cash flow buy more properties? And we think of it as your babies giving babies, so your grandchildren, if you will. And we're about to have our first grand house next month or so. We're expecting. So we're pretty excited.
Great. Wonderful. Ben.
Yes.
Your strategy when you started, give us a little bit of your history, because you were investing far before Real Wealth Network.
Yeah, I've been in real estate on the side for about 26 years while toiling endlessly in the hotel audiovisual field. And initially just bought a condo in Oakland that I rented out, and then I had a house in Walnut Creek that I lived in and then converted to a rental. And actually, before that, when I got out of college, it was too expensive around here. I'm 47, so this is like, late 1989 or something. So I moved to Arizona in like 1992, and you could buy houses in Arizona under the VA program, although I wasn't a veteran. You didn't need to qualify, which I couldn't. I was out of college, unemployed kid. 10% down, and the houses were about $70,000. So scraped up $7,000 plus maybe $1,000 or $2 for closing costs. You could buy a house in Arizona, not even have to qualify. I mean, this is then. They don't do that now. I know. They had their big boom and bust, and that was a bust cycle. And so I got into 2 houses there, and then ended up starting to do fix and flips, and did that for a while, and so I've had the bug for a long time. And then I don't exactly remember how I stumbled across, I think KSFO, I believe. One Sunday I'm driving to Home Depot, there you are, talking. So I became a member and learned about Pittsburgh. Took a trip out to Cleveland and Pittsburgh in one trip, and then Cincinnati in another trip, and just ended up buying 3 houses in Cincinnati by converting an IRA, because my company I no longer work for, I had this big IRA, being cleaved in half in 2008 in the stock market and slowly climbing back, and I was just sick of it. So I thought, okay, let's just roll it over and get property, because the properties that they had been steadily appreciating. You know, not very much, which is in Arizona, so they went up slowly. But meanwhile, like we've all experienced, the 2008, the roller coaster of the stock market. Of course, real estate went down there too, but it depends on where you were. So I ended up having 1 in Cleveland, 1 in Pittsburgh, 3 in Cincinnati, and I still own 1 in Arizona. So I'm just slowly building up.
So you didn't necessarily have a strategy to begin with?
Well, not as much of a strategy as I would like to have, and not nearly as much of a strategy that I coach and counsel people and we try to come up with. You know, I have a strategy now, which is, and I use my standard example that I use for everybody, and I think you even mentioned, to buy a $100,000 house in Cincinnati, San Antonio, Houston, Dallas, you know, any of Chicago, any of our cities. Let's just use a $100,000 house as your basic example. Put $20,000 or 20% down. So now you've got an $80,000 loan. Your costs are probably going to be about $650 a month. That's principal, interest, taxes, insurance, and management. This is generally speaking, this is an accurate example. So $1,000 coming in, $650 going out. And you know, the first 3 or 4 months, don't spend that money. Let it build up into a nice reserve for the inevitable insurance deductible or a tenant vacancy. And once you hit that 3 or 4 months of reserves, then start paying it down in advance. And every time I run the scenarios, whether it's 1 house or 10 houses, seems like it takes about 12 years, just like Wayne, you mentioned from Missy's example. About 11 to 12 years, and they're all paid off, assuming you use positive cash flow to pay off number 1, number 2, and number 3, and they start falling like dominoes, each domino quicker than the last one. And then, so my goal is to have 15 of these little money spitting out boxes scattered around the country in maybe 2 or maybe 3 markets. And using that math, the other example I always use is that $1,000 house that's giving you 350 positive cash flow now. Once you pay off the loan in 12 years, that 350 becomes 750. The logic being $1,000 for rent, 250 for taxes, insurance, and management. But there's no P&I anymore, so that 350 becomes 750. So I just do the math from there. 10 times 750, if I had 10 properties, would be $7,500 a month of passive income, or $90,000 a year. My goal is 15, which pushes that $90,000 up to $135. So I'm about halfway there. But so I walk through that with most people that seem interested. Well, if we get to that strategy session, and you can kind of see the light bulb go on, and everyone's like, wow. Because once your down payment is done, you don't really have to put any more money into it, ever. I mean, assuming you have those reserves. Because things will come up, but the reserves will take care of those things, and you still are on the 12-year plan.
Great,
Yeah.
thank you. Okay, I just want to address one thing you said, Wayne, which was that, I don't remember exactly how you said it, but that people don't change, or that you can, you know, do you remember you said something like that? You trust these people and people don't tend to change. Is that 2 more minutes to the next? Okay, yes, we're good. They do. They do. The people you've worked with haven't. They're still churning out the same quality they have. But this is something we're going to talk about in the next section, or not the section after this, which is due diligence, which is certainly at the beginning, and I don't know everybody thinks of due diligence as all the work you do ahead of time in preparation for purchasing that property. But there's also due diligence that needs to happen afterwards. So what we have found in this business, and there's probably people in the room that have experienced it, is that people do change sometimes. And it could be just life has happened, and things have happened that change the circumstances for that person, and the quality of their services is impacted from that. And so, you went to Cleveland, and I don't think, well, you could go on and on and on about that situation.
Right.
But we had, and I know there's people in the room, myself included, who purchased property from this guy in Cleveland. Cleveland's one of my favorite markets, but he had some personal things go on, and the property management company imploded, and we had to react quickly. And that's why you're not seeing that person on our website anymore. So the value that we have at Real Wealth Network is communication, that we can share with each other when things like that happen. Because the way that Real Wealth Network's working on being better, and our goal this year, is to recognize these things more quickly. And so in this case, the the property manager just, we don't really know quite what happened, but something happened and people were stopped not getting their rent on time. And it could be that, you know, a lot of times these smaller property management companies that don't necessarily know how to manage their staff and their teams, they overspend and suddenly their cash flow poor and you're starting to see your rents come slower.
They rob from Peter to pay Paul and hope nobody notices. Well, people will notice.
You're going to notice. So the way we're improving as a company is seeing that sooner, and we're so happy to let you know, next month we're going to bring our newest employee to meet you, who is a Black Belt Six Sigma. You know what that is? Anybody know what that is? I didn't either. I just kind of stared at him blankly and said, good for you. And where are you fighting? I don't know. And how does that help us? Are you going to go fight some of these guys? That would be good. But it turns out it's somebody, a very, very high level, high training for systems. And he's out in Ohio. And so he's very close, within an hour, 2 hours drive from the different markets that we are really excited about. And he is going to be overseeing their systems ongoing. And this was a big expense for us, but we are so excited to be able to actually not even be reactive anymore, because it's been like, okay, the first time we get a complaint, let's go out there and see it. We want to be before that.
Proactive.
So, proactive, where Tim is going in and looking at their systems and auditing to make sure that these property managers aren't getting behind and that they're not overhiring and so forth. So anyway, I just wanted to address that because we're going to talk about due diligence. And the wonderful thing about real estate is that you have so many protective factors there that even if a person does change, you can protect yourself in advance. So I just don't want anybody going in blindly saying, this is a good person, and Wayne said they're great, so I'm going to just trust them blindly. Okay? I just want to make that clear.
I mean, sometimes people become victims of their own success. You know, things are going gangbusters. They're buying and renovating property, and they have happy people, and they're happy, and they get bigger, and they get bigger, and they don't know how to hire, and so they don't, and they think they can handle it, and they can't, and services go down, and they're in denial over it. And so with Tim, he'll spot those things in advance by asking, I don't know, he's developing a system with 50 questions he's going to ask everybody, and then he's going to go back every quarter and just kind of keep an aggregate score. And then how that translates is people or affiliates that are suffering in one area or another, or maybe not quite up to par, then when Aristotle, our other investment counselor, and myself are talking to people, we might tend to steer people a little bit away. We'll ratchet back on those markets that maybe have a couple of Achilles heels that we've developed proactively or recognized proactively.
Yeah, so we're really excited. But the best part of that is that Tim is going to create these systems and work with all of our teams to help create best practices and look at it more as, yes, we're overseeing them. That's the goal. We want to be making sure they're doing their job. But instead of treating it more like a bully kind of way, like it's more like, we want you to succeed.
Right.
We want, here's what Missy's doing that is working time after time after time. How can we take those systems and bring them to everybody else?
Yep.
So
it's not adversarial. We're working with them. That's part of this.
Trying to help them grow and be successful as well.